Welcome to the deep dive. Today we're getting into Morgan Stanley's first quarter 2025 earnings.
Yep, the goal is really to sift through the numbers, look at revenue, different divisions, their overall financial shape.
Exactly. And we're basing this on their official release, the one dated April 11th, 2025.
Straight from the source. It gives us a direct look at Q1 this year compared to Q1 last year. See what's changed.
And for you listening, we want to make sense of the big number, what's behind them, and maybe what they signal for the wider financial world. No jargon overload, just the essentials.
Right, so let's dive in. Overall financial performance first.
Yeah. I mean, my first glance suggests it was a really strong quarter. What jumped out at you? Anything concerning?
It was definitely strong.
Yeah.
I mean, the headline number, record net revenues,
Yeah.
$17.7 billion.
$17.7 billion. Wow, that's up from what, about $15.1 billion last year?
Exactly, a 17% increase. That's
Yeah.
$2.6 billion more year over year. Significant growth.
It really is. What do you think were the main things pushing that jump?
Well, we'll get into the segments, but it seems pretty broad-based. But before that, profitability, right? Net income.
Right, how did that look? Because revenue's one thing, profit's another.
Also very healthy. Net income hit $4.3 billion. That works out to $2.60 per diluted share.
Compared to last year.
Last year was $3.4 billion, or 2.02 per share. So you're looking at a 26% rise in net income and 29% in earnings per share.
Okay, so not just more money coming in, but they kept more of it, relatively speaking, on a per-share basis. That's key.
Definitely. Signals good underlying health efficiency.
Now, they also mentioned ROTCE, return on tangible common equity. That was up too, wasn't it?
It was up to 23.0% from 19.7% last year.
And that tells us.
Basically, how well they're using shareholder capital, the tangible stuff, to make profit. A jump like that suggests, better efficiency in putting capital to work.
Makes sense. And speaking of efficiency, the expense ratio improved.
Yeah, down to 68% from 71%. Lower is better here.
So for every dollar they made, they spent 68 cents running the business, down from 71 cents.
Pretty much. But important point here, their expenses included $144 million in severance costs.
Ah, right. They had that employee action back in March. Affected about 2% of the workforce.
That's the one.
Yeah.
So the efficiency gain is there, but you have to factor in that one-off cost, too. It wasn't just pure operational tightening.
Got it. Okay, let's move into the business segments. Institutional securities, wealth management, investment management. Where should we start?
How about institutional securities? That seemed like a real powerhouse this quarter.
Okay. What were the numbers there?
Record net revenues,
Oh.
$9.0 billion. That's up from $7.0 billion a year ago. Big jump.
$2 billion more. Wow, what drove that?
Well, the big story was equities, also a record $4.1 billion in revenue.
$4.1 billion just from equities. That's, what, a 45% increase?
Yeah, huge. The report points to really strong client activity.
Yeah.
Prime brokerage, derivative.
Anything specific there? Market conditions, geography?
They specifically called out strengths in Asia. Seems like clients were very active there. Prime brokerage and derivatives really benefited.
Interesting. So Asia was a key driver. What about the investment banking side of institutional?
Also strong. $1.6 billion in revenue, up 8%. That came from more advisory work and good results in fixed income underwriting. Deals are happening.
So trading and deal making, both firing on cylinders. Did fixed income overall contribute?
It did, yeah. Revenues were up 5%. Modest, but still up. Areas like foreign exchange and securitized products did well.
But sounds like there might be a but.
Well, yeah, it's a slight offset. Lower revenues in credit products held it back a little. So positive overall, but a bit mixed within fixed income itself.
Okay. Now, I did see something about credit loss provisions in this segment. They increased.
They did. That's definitely something to watch.
Why the increase? More loans going bad.
Two reasons cited. One, simple loan growth. They have more loans out there. Two, a weaker macroeconomic forecast.
Ah, so they're setting aside more money because they see potential bumps in the road ahead, economically speaking.
Exactly. Even with record revenues, they're being cautious about credit quality given the broader outlook. A bit of prudent planning, perhaps.
Right. Makes sense. Okay, let's pivot. Wealth management. Huge part of their business. How did that division look?
Also solid. Net revenues were $7.3 billion,
Yeah.
up from $6.9 billion. And a good pre-tax margin, 26.6%.
What fueled that growth? Similar drivers.
Kind of a mix. Higher asset management revenues played a big part. That's driven by higher asset levels Generally, markets have been okay and also flows into their fee-based accounts.
So clients' money growing and more clients choosing those advisory accounts. That makes sense. What else?
Transactional revenues were up 13% if you exclude some noise from deferred compensation plans.
Deferred comp, right? That can swing things around sometimes. So excluding that, clients were trading more.
Seems so, yeah,
Yeah.
especially equities. And then net interest income was also up,
How come? Interest rates.
partly driven by more lending to wealth clients plus higher yields on their investment portfolio, though that was partly offset because balances in sweep accounts were lower.
Okay, so growth from fees, trading, and interest income. Pretty broad strength there, too.
Definitely.
Now, did wealth management also see higher provisions for credit losses?
It did, yes, but the reason was a bit different here.
Oh, not the macro outlook.
Less so. It was more about specific loans. Higher individual loan assessments, and they specifically mentioned residential mortgages linked to the California wildfires.
Ah, okay. So more localized issues impacting specific borrowers in that portfolio rather than a general economic worry.
That seems to be the main story for the wealth management provision, yeah.
Makes sense. And one number that really stood out for me from wealth management was the net new assets. $94 billion.
Yeah, that's huge. A really substantial inflow of client money.
What does a number like that tell you?
It really underlines how strong their franchise is,
Mm-hmm.
attracting $94 billion in a single quarter. It shows they're very effective at bringing in new clients and keeping existing ones happy. Crucial for long-term growth.
Absolutely. Okay, final segment, investment management. How did they fare?
Pretty good. Net revenues hit $1.6 billion, up from $1.4 billion last year.
And the main driver there.
Mostly higher asset management fees. Their average assets under management, or AUM, climbed to $1.7 trillion. More assets under management generally means more fee revenue. Simple as that.
So benefiting from market appreciation and maybe attracting assets, did they see inflows?
They did. Positive long-term net flows of $5.4 billion in the quarter.
So money is coming in, not going out on balance.
Right. And another boost came from performance-based income. Specifically, higher accrued carried interest, particularly in their infrastructure funds.
Carried interest, so basically getting a share of the profits because certain funds performed well.
Exactly. Success in specific strategies like infrastructure added to the top line there.
Interesting. Okay, so we've covered the segments, all showing pretty positive results. Let's talk capital and shareholder returns, CET1 ratio.
Right. They added $1.9 billion of common equity Tier 1 capital, ended the quarter with a standardized CET1 ratio of 15.3%.
And 15.3%, that's considered strong.
Yeah. Very strong. Well above regulatory minimums. It gives them a solid buffer, lots of financial flexibility.
Good cushion. And returning capital, buybacks, dividends.
Yep, both. They bought back $1 billion of their own stock during the quarter.
At what price? I remember seeing that.
Average price was $125.88 per share, which is quite a bit higher than the $86.79 average they paid back in Q1 2024.
Shows how much the stock has run up, but they're still buying back. Reduces the share count.
Exactly. Still committed to that. And dividends.
Did they announce the next one?
They did. Declared a quarterly dividend of 0.925 AS per share, payable mid-May.
So consistent on the dividend front, too. That's usually seen as a good sign, right? Stability.
Generally, yes.
Yeah.
Regular dividends plus buybacks show a clear strategy to return cash to shareholders.
Okay. Before we kind of wrap this section up, any other notable points from the report we should mention? Anything else catch your eye?
A couple of things. Total client assets across wealth and investment management combined, $7.7 trillion. That's a huge number, helped by that $94 billion net new asset figure.
$7.7 trillion.
Wow. Also, employee count is up slightly, 2% year over year. Just over 81,000 employees worldwide.
Yeah.
And tax rate was 21.2% for the quarter. They mentioned a benefit related to employee share-based compensation helped keep that relatively low.
Right. And people can always dig into the full report for definitions of non-GAAP measures and all that.
Absolutely. The details are all in there if you want the nitty-gritty.
Okay, so let's try and pull this all together. Our deep dive into Morgan Stanley's Q1. I mean, it clearly shows a very strong start to 2025.
No doubt about it. Record revenues.
Driven by really solid performance across the board, wasn't it? Institutional securities, wealth management, investment management.
Yeah, it wasn't just one area carrying the load. All three main engines were firing.
Plus, healthy capital levels, that strong CET1 ratio, and they're continuing to send money back to shareholders through buybacks and dividends.
That sums it up pretty well. The breadth of the strength across the businesses is maybe the most impressive part.
Yeah, I agree. So, if we step back for a second, What could this tell us about the broader financial sector or the economy?
Well, it could suggest a pretty positive trend, couldn't it? You see strong market activity, especially in equities and investment banking, reflected in results like these.
And a major player like Morgan Stanley capitalizing on it effectively.
Right. Plus, that big inflow of net new assets in wealth management that suggests investors are still confident, still putting money to work, at least in that part of the market.
There's always a but, isn't there? We talked about those increased provisions for credit losses.
Exactly. That's the note of caution, isn't it? Across both institutional securities and wealth management.
How much weight should we give that? Is it just prudent planning or a sign of real concern?
It's the big question going forward, I think.
Mm.
While Q1 was great, those higher provisions signal they're bracing for potential challenges. Maybe a softer economy, maybe more defaults.
So, something to definitely keep an eye on in the next few quarters. See if those provisions continue to rise or if the losses actually materialize.
Precisely. It could impact future profits if things do slow down.
Okay, so for everyone listening, maybe something to think about is how the results of a giant like Morgan Stanley, touching so many parts of the financial system, can be a kind of bellwether.
Yeah, it offers insights into global economic health, different asset classes. It's all interconnected.
So the question to ponder might be, based on these strong results, but also that note of caution on credit, where do you see the most strength or potential weakness in the financial markets for the rest of the year?
Good question. Lots to think about there as we move through 2025.
Definitely. Well, thanks for joining us on this deep dive.